Good morning, good evening, all of you. Could you first please confirm, am I audible? Am I visible? Good evening, Krishna. Krishna, could you please confirm, am I audible and am I visible? Oh, okay. Thank you, Rupa. Guys, welcome to the live YouTube. Welcome to the revision session of Group 1 CA Intermediate Accounts. In this session, we will be revising investment accounting. We will be revising in the next session hire purchase. These are the two chapters which we will be revising today: investment accounting and hire purchase. Before we start with investment accounting, Unacademy has come up with an iconic program which is one of the best programs of Unacademy, offered by Unacademy for CA intermediate aspirants. In this program, there are lots and lots of features and benefits available to the students. One-to-one personal coaching, one-to-one doubt solving, evaluated test series, printed books will be available. Industry expert session. According to me, industry expert session is one of the best features in this iconic program and live mentoring platform. See, after clearing CA intermediate examinations, many students have this confusion where to join articleship, what kind of work should I do. So when you talk to people or discuss with people who are already working in the industry, they will help you or guide you in a better way, that where you should do articleship and where is your interest, and in a particular area what kind of work you can expect, etc. So this is one of the best features of the live mentoring platform according to me. Of course, live classes, weekly tests, study materials, unlimited access of the recordings. And from any device you can see the recordings. And the course will also be structured. Uh, you don't have to, if you join a particular course, you don't have to, every 15-20 days, you don't have to search or roam around that which is the next subject I have to study. That particular batch may, every faculty within their respective time periods will complete the syllabus. They will come and they will complete the syllabus. You just have to subscribe to that particular, follow that particular batch. The iconic subscription for 6 months will cost you 5,000 per month. And when you are taking the subscription, all you have to do is that go to Play Store, download an Unacademy app, click on the course which you want to purchase, click on subscribe, pay the money, use the code Yeshas Live. The prices will fall, you will get discount. And a mega combat for CA foundation students is being held on 28th November at 12 p.m. in which 60 minutes में 40 questions a student has to attend. Up to 100% scholarship from a pool of 1 crore. And 100 lucky participants are also going to win surprise gifts. Enroll yourself, and while enrolling yourself, use the code Yashas Live. In 60 minutes, you have to attend 40 questions. This is for CA Foundation Mega Combat tests, where a lot of prizes can be won. Fine. Let's start with today's revision session. Good evening, all of you. Let's start with today's revision session. First, we are going to discuss investment accounting. We are going to revise investment accounting. Investments are those assets which are held by an entity for earning income by way of interest or by way of dividend or by way of rentals, and also these are held for capital appreciation. So investments are those assets which are held by an entity for earning income. For earning income from which source? For earning income by way of interest, dividend, rentals, and for capital appreciation. Then it is called investments. But you have to be careful over here. If any asset is held as stock in trade, then it will not be classified as investments. Therefore, stock in trade will not be part of investments. If any entity in its ordinary course of business buys and sells shares, debentures, properties in the ordinary course of business, then the assets held will be classified as stock in trade and not investments. Second point, Accounting Standard 13 deals with yes, Sindhu, I will share it in this particular class. I will share the important questions for profit and loss prior to incorporation, bonus issue. Right issue I already told. Right issue के लिए that X right price and value of right is the kind of question which they ask. For the rest of the chapters, I will share the important questions today with you all. But it doesn't mean that you will only do those questions and go to examination. You do everything and go, but those questions you revise more properly and then enter the examination. All these are frequently asked questions. I will tell you which are the questions which you should be revising properly in case of the other chapters. After we have completed the revision of investment accounting, I will tell you. So everybody, Accounting Standard 13 deals with accounting for investments. Let me tell you, it does not deal with accounting for income from investments. Yeah, it does not deal with accounting for income from investments. It deals with accounting for investments, not accounting for income from investments. As per Accounting Standard 13, investments are classified into two categories: current investments, long-term investments. Good evening, Manoj. Current investment is an investment which by its nature is readily realizable and is intended to be held for not more than 12 months or 1 year from the date on which such investment is made. Suppose we have purchased an investment on 2nd of Feb 2021. Then on 31st March 21, these investments can either be classified as current investments or it can be classified as non-current investments, depending on whether we intend to hold, depending on the intention to hold. Actual period for which investments are held is of no use. I repeat once again, this example is important. On 2nd of Feb 2021, we purchased investment. On 31st March 2021, these investments which we purchased on 2nd of Feb 2021 can be classified either as current investments or non-current investments, depending upon the intention to hold these investments. Actual period for which we have already held these investments are of no use. Suppose investment is done on 1st of April 2020 with an intention to hold it for 15 months. So 1st April 2020, we made investments with an intention to hold it for 15 months. How will this investment be classified on 31st March 21? 1st April 2020, we purchased investments with an intention to hold it for 15 months. How will these investments be classified on 31st March 2021 as per AS 13? Guys, as the investments are intended to be held for more than 1 year from the date on which they were bought, as per AS 13, it will be classified as long-term investment. So on 31st March 2021, as per AS 13, it will be classified as long-term investments. I repeat, on 1st April 2020, we purchased investments with an intention of holding it for 15 months. On 31st March 21, how these investments will be classified as per AS 13? Long-term investments. AS 13 does not consider the period remaining from the balance sheet date. Yeah, it doesn't consider the period remaining from the balance sheet date. From the balance sheet date, 3 months are left for these investments to be realized. AS 13 does not consider the period remaining from the balance sheet date. However, for presentation in balance sheet, on the face of the balance sheet, we need to consider the requirements of Schedule 3 of Companies Act 2013. As per Schedule 3, an asset is classified as current asset if it is expected to be realized within 12 months from the balance sheet date, from the reporting date. So in the present example which we were discussing, the investments would be realized within 3 months from the balance sheet date. Therefore, for presentation in balance sheet, for presentation in balance sheet, investments will be classified as current investments. But as per AS 13, those investments are long-term investments. But as per Schedule 3 for presentation in balance sheet, those investments will be classified as current assets. Fine, sir. So this point we will keep in our mind. Next, because as per Accounting Standard 13, current investment should be shown in the balance sheet at cost or fair value. Fair value in cheap language is market value. Fair value is like market value, whichever is lower. As per AS 13, current investment should be carried in the balance sheet, shown in the balance sheet at cost or fair value like market value, whichever is lower. Guys, the comparison of cost and market value, fair value, should be done on individual basis, not on accumulated basis. Not on accumulated basis. Now, those who are writing both the groups, group 1 and group 2 both, in NBFC chapter, in valuation of investment, we do the selection of cost and market value, whichever is lower, not on individual basis but on group basis. But for entities other than NBFCs, we do the selection of cost or market value, whichever is lower, on individual basis. Those who are writing both the groups, group 1, group 2 both, for them I told this difference. Fine, sir. Now, as per Accounting Standard 30, long-term investments are generally shown in the balance sheet, are carried in the balance sheet at cost. Long-term investments are carried at cost. But guys, if there is a decline other than temporary, if there is a decline in the value of investment other than temporary, that is permanent nature kind of decline, then long-term investments will be, the value of the long-term investments will be reduced to recognize the decline. For example, we have purchased investments for 100 rupees. Market value on the balance sheet date is 90 rupees. Market value on the balance sheet date is 90 rupees. If these investments are current investments, in the balance sheet these investments will be shown at 90. But if these investments are long-term investments, and if the decline is temporary decline, then we will show the investments at 100. But if the decline is permanent decline, it is not temporary, then we will show the investments, long-term investments also at 90 rupees. Next topic, cost of investment. Guys, cost of investment means how much money did you spend in buying the investments. As per AS 13, cost of investment, when you buy investment, when you spend money in buying investment, cost of investment will include purchase price, it will include brokerage, it will include taxes and duties. But if the investments are acquired not in cash, but they are acquired in exchange of another asset, it is acquired by exchange of another asset, then the cost of investment will be fair value of the asset given up, or the asset which you are giving uska fair value, or the fair value of investments which we have acquired, whichever is more reliably and clearly evident and measured, that is the value at which we will recognize those investments in our books. So if investments are acquired for cash, then the cost of investment will include the purchase price, brokerage, duties, taxes, fees, etc. If the investments are acquired in exchange of another asset, then fair value of the asset given or the fair value of investment acquired, whichever is more clearly evident. And if the investments are acquired by issue of shares, then the cost of investment will be equal to the fair value of securities or shares issued. If we have acquired investment by giving shares, then those investments ka cost will be taken to be equal to the fair value of the shares and securities which we have issued to acquire those investments. Fine. Next point, classification of investments. Guys, investments are classified on the basis of income. On the basis of income, investments are classified into two categories. On the basis of income, I am saying, on the basis of income, investments are classified into two categories. Number one, fixed income bearing security. Fixed income bearing security. Number two, variable income bearing security. Now, what is this fixed income bearing security? Fixed income bearing security are those securities which give fixed income periodically to the holder of the investment. Variable income bearing security, example of fixed income bearing security is investment in debenture, then government bonds, etc. Variable income bearing securities are those securities which do not give fixed income. The income would vary based on the profits of the company whose securities we have purchased. And example of variable income bearing security is investment in equity shares. Then first we are going to discuss the accounting for how do we do accounting for fixed income bearing securities. Maltesh, in that case, then the management has to decide which they feel is a a better way of measuring it, and accordingly they will take up that only. That is the value at which they will measure the investments. Then it is upon management. The decision is upon management. Now, accounting for fixed income bearing securities. Guys, under fixed income bearing securities, the company which has issued the securities will pay fixed interest periodically on specific dates to the holder of the securities. So if Mayur sir has purchased Punjab government bonds, Karnataka government bonds, Haryana government bonds, Uttar Pradesh government bonds, if Mayur sir has purchased debentures of Infosys, or I have purchased debentures of Hindustan Unilever, then I will receive fixed interest periodically on specific dates from the governments and from the company whose debt security I have purchased. Suppose interest date is 30th June and 31st December. Yeah, Maltesh, for exam purpose only, then you have to write both the notes in exam. You have to give both the options in exam. The management has to decide, etc. Like this, you will write the theory. Now, suppose the interest date is 30th June and 31st December. Then the company whose securities I have purchased and the government whose bonds I have purchased will pay 6 months interest to me on 30th June and will pay 6 months interest on 31st December to the person who is holding such bonds and debenture on 30th June and 31st December. Whoever is holding those bonds and debenture on 30th June and 31st December, the company which has issued such bonds and debentures will pay interest of the entire 6 months to whoever is holding the bonds and debenture on the interest payment date, irrespective of the period for which that person has held the investments. Suppose Mayur sir purchased debentures from the stock market of Hindustan Unilever on 1st of January. Interest payment date is 30th June. So in the current case, on 31st December, Mayur sir will receive interest for 6 months. This will be, if Mayur sir receives interest for 6 months, this will be not fair to the previous owner, because guys, previous owner has held these investments till 1st of November. So the 5 months ka interest belongs to the previous owner. 1 month ka interest or 2 months ka interest belongs to me. So at the time of buying the securities, I will pay the 2 months ka interest to the seller of the investment. Once again, I will repeat the example. Suppose Mayur sir has bought the debentures of Hindustan Unilever and the interest dates are 30th June and 31st December. I purchased the investment on 1st of November. On 31st December, my name is appearing as a holder of debenture of Hindustan Unilever. Hindustan Unilever will give me full 6 months ka interest, but it will not be fair to the previous owner, because actually I was holding the investments only for 2 months, November and December. For 4 months, the previous owner was holding the investments. So 4 months ka interest should go to the previous owner, 2 months ka interest should come to me, but company will not bifurcate and give the interest of 4 months to the previous owner and 2 months ka interest to me. Company will give me full 6 months ka interest. While purchasing the debentures of Hindustan Unilever, I have to pay 4 months ka interest to the previous owner. So what is the conclusion? Under fixed income bearing securities, whenever investments are purchased, the buyer, Mayur sir, has to pay for 2 things. Number 1, I have to pay some amount towards investment, debenture of Hindustan Unilever, and number 2, I have to pay some amount towards accrued interest. So in the example which we were discussing, on 1st of November, that is at the time of purchase, Mayur sir will pay interest of 4 months to the previous owner, and Mayur sir will receive 6 months interest on 31st December from the company. 4-month interest goes to the previous owner. Net effect, 4 months interest goes to the previous owner, 2 months interest will come to Mayur sir. Next, purchase price of fixed income bearing security. Purchase price of fixed income bearing securities can be either cum interest or it can be ex interest. Suppose you go to Unacademy and you purchase the subscription from Unacademy. Now, Unacademy can quote the price in two ways. Unacademy will tell 10,000 plus GST, or they will say 11,800 including GST. So these are two ways by which Unacademy can quote the price to you. 10,000 plus GST, 11,800 including GST. Same way, when Mayur sir goes to the stock market to purchase the debentures of Hindustan Unilever, the seller of the debenture can give me the price, can quote the price in two ways. One is cum interest, one is ex interest. Cum interest means the price includes the interest amount. This means that the price is which he is asking from me, in that price some amount is towards investment and some amount is towards accrued interest. Ex interest price means the price excludes interest. This means that the price is only towards investment. Interest is to be paid additionally. Unacademy is telling 10,000 plus GST. This is called ex GST price. So 10,000 we have to pay for coaching fees and additionally we have to pay GST also. 11,800 will be called cum GST price. It includes an amount towards coaching also and it includes the amount towards GST also. So cum interest price means that price includes interest also and amount towards investment also. Ex interest price means that amount is solely towards investment. Interest has to be paid additionally. Say for example, Mr. Mayur sir purchased debentures at 102 rupees. I am purchasing debentures at 102. Suppose the accrued interest is 4 rupees. The date on which I have purchased the investment, till that date 4 rupees ka interest has become due. What will be the total payment which Mayur sir has to make if the price quoted by the seller is cum interest? If the price quoted by the seller is cum interest, then I have to pay 102 only. But if the price quoted by the seller is ex interest, then I have to pay 102 towards investment and 4 rupees I have to pay additionally towards interest. So totally I have to pay 106. Now journal entries. Guys, journal entries for purchase of fixed income bearing security will be when we purchase fixed income bearing security, the journal entry is investment account debit. Investment will be debited with the amount which we have paid towards investment. Interest account debit to bank. So investment account will be debited with the amount which the purchaser of the investment has paid towards investment. Interest account will be debited for the accrued interest, because if I am buying the investment on 1st of November, I have to pay to the previous owner 4 months ka interest and I have to pay some amount towards investment also. So the amount which I have to pay towards accrued interest will be debited to interest account and the amount which I have to pay towards investment will be debited to investment account and the bank account will be credited with the total payment. Fine, sir. This is the first point. Second, sir, I have a doubt in entry. Year-end date of interest is different. Yes, Maltesh, I will explain that also. Maltesh, I will come to that point. Just give me 5 minutes. We'll be discussing that. Second, for interest received on investment. So when we receive interest on investment, entry will be bank account debit to interest account. Third, for sale of investment, when the investments are sold, the entries are very simple. When the investment is sold, all of you, you have to be careful again. When we are selling the investment, the total amount received will be debited to bank account, and the total amount, some amount we have received towards investment and some amount we have received towards interest, both will be included. The total amount received. Investment account will be credited with the amount which we have received towards investment. Because when we will be selling investment, we will be collecting also two things. When we were buying investment, we paid for two things: accrued interest and some amount towards investment, debentures of Hindustan Unilever. When we are selling investment, we will collect also two things: accrued interest, and we will also collect some amount towards the debenture of Hindustan Unilever. Bank account will be debited with the total amount received. Investment account will be credited with the amount received towards investment. Amount received towards investment. And interest account will be credited with the amount received towards interest. Amount received towards interest. This is the entry which we record for sale of investment. Profit or loss on sale of investment. Now, very, very important point. Profit or loss on sale of investment. Profit or loss on sale of investment would be found by comparing the amount received towards investment and the amount paid towards investment earlier. So profit or loss on sale of investment will be determined by comparing the amount received towards investment and amount paid for investments earlier. Investment earlier. This is how the profit or loss will be determined. If there is a profit, entry will be investment account debit to PL. If there is a loss, then the entry will be P&L account debit to investment. P&L account debit to investment. At year end, the balance of interest will be transferred to P&L account. So entry will be interest to P&L. At year end, the balance of investment account will appear as an asset in the balance sheet. If it is current investments, it will be carried in the balance sheet at cost or fair value, whichever is lower. If it is long-term investment, it will be generally carried at cost unless there is a decline which is other than temporary. Any decline in the value or any reversal of decline will be transferred to P&L account. So at year end, interest column balancing figure will be transferred to PL. Investment accounts balance, the balance of investment account will be shown in the asset side of the balance sheet. If it is current investment, it will be carried in balance sheet at cost. And if it is long-term investments, it will be carried at cost. If it is current investment, at cost or fair value, whichever is lower. If it is long-term investment, it will be carried at cost until there is a permanent decline, a decline other than temporary. Any decline or reversal will be transferred to P&L account. For decline, the entry will be P&L account debit to investment, and for reversal of decline, entry will be investment account debit to PL. investment account debit to PL. Now, I will take the doubt of Maltesh. Now, Maltesh, listen. If Mayur Sir's accounting year is from 1st of January and it ends on 31st December. Mayur Sir ka accounting year is 1st of January, starts on 1st of January and ends on 31st December. I have purchased the debentures of Hindustan Unilever. Hindustan Unilever pays interest on 30th June and 31st December. Then there will be no accrued interest entry required neither at the beginning of the year nor at the end of the year, because whatever interest we have earned during the year, all those interest we have received also. So no accrued interest entry is required. If the accounting year ending and interest date is same, if the interest date and year end date are same, then no accrued interest entry is required. But suppose Maltesh, case 2. Suppose Maltesh, my accounting year is 1st April to 31st March and Hindustan Unilever ka debentures gives interest on 30th June and 31st December. Now on 31st March 2021, 3 months ka interest is accrued, earned but not yet received. So on this date, we have to pass accrued interest entry. Accrued interest account debit to interest account. This entry we will record. And at the beginning of the next year, this entry we will reverse it. At the beginning of the next year, this entry we will reverse it. Interest account debit to accrued interest account. I hope so you are asking about this only, Maltesh. So whenever interest date and accounting year date are not same, then we do this kind of adjustment. Is it fine, Maltesh? Okay. So this is the journal entry which we have to record for accrued interest. Then next topic of discussion. Guys, if the question is silent and the price given is, if the question is silent about whether it is cum interest price or X interest price, assume that it is X interest price. This is the assumption done by ICA. If the question is silent about cum interest price, X interest price, assume that it is X interest price. This is the assumption which ICA does. Next, when we are determining the profit or loss on sale of investment, I told you we have to compare the amount received towards investment with the amount paid towards investment earlier. So we have to compare the amount received towards investment with the cost of investment sold. Guys, the cost of investment sold can be determined by either using weighted average method, would be found out by using weighted average method as per accounting standard 13. Similarly, the cost of investment remaining unsold which appears in the balance sheet will also be determined based on weighted average method. So when the question is silent, the cost of investment sold will be determined on the basis of weighted average method, not on the basis of FIFO. but on the basis of weighted average method. And even the investments remaining which will appear in the balance sheet, will also be based on the weighted average method as per AS 13. Use FIFO method only when the question tells. Otherwise, never use FIFO method. Next, separate investment account is prepared for each of the securities. If I have purchased debentures of Hindustan Unilever and Mayur Sir has also purchased debentures of Tata Company, then investment in debentures of Hindustan Unilever will be a separate investment account. Investment in debentures of Tata Motors will be a separate investment account. Don't prepare a common investment account and record the acquisition entries, income entries, interest entries of both the debentures of different companies in one single account. No. Separate investment account is prepared for each of the securities. The format of investment account is, although every book may different format are there, you can follow any format. Date particulars, nominal value, interest cost. Different books may different formats are there, but these are the main columns which will be there. Date, particulars, nominal value, interest cost. Date, particulars, in whatever sequence you write, doesn't matter, except the first two columns should be same, date and particulars. They should come in this sequence only. Then nominal value, interest cost. Totally 1, 2, 3, 4, 5. 10 columns are there. 5 on the left hand side, 5 on the right hand side. Now, few important points which we have to discuss. Important point number 1. Guys, whenever the purchase and sale of securities happens on the interest date, then first we will always record the purchase and sale entry, and then we will record the interest entry. That is the first important point which you have to remember. If purchase and sale of investment takes place on the interest date, suppose interest date is 30th June, and on this date only you have bought or we have sold some investments, then first pass the entries for purchase and sale of investment, then record the interest entry. Interest will be received only on the remaining investment, because on the investment which we have sold, we have already received the accrued interest till the date of sale from the purchaser. So now we will receive interest only for the balance investments. In simple language, if on the interest date there is purchase and sale as well as interest, then first record the purchase and sale transaction, then record the interest entry. Second, which I have already repeated, but once again we have already discussed, but once again I will repeat. Whenever year ending date is not equal to interest date, then whenever year ending and interest date are not same, then we have to do the accounting as under. First, step number 1. At year end, we need to pass an entry for accrued interest. Step number 2, at the beginning of next year, we have to reverse the above entry. Interest account debit to accrued interest. And whenever the interest payment date comes, normal entry for interest received will be made. Normal entry for interest received will be made. Bank account debit to interest. So whenever year ending date is not equal to interest date, then at year end we have to pass this entry. At the beginning of next year we have to reverse the above entry, and on the interest date pass the normal entry for receipt of interest. These 3 steps you have to keep in your mind. These steps are followed to ensure that interest of the respective period goes to the respective year. Next important point. I just hope you are taking a note of the important points which we are discussing. Next important point is, if the brokerage is given in percentage. Yes, if the question gives you brokerage in percentage. Guys, let me see how many of you can answer. Will you apply the brokerage percentage on the face value of the securities or on the purchase price and sale price of the securities? If the brokerage is given in percentage, will we apply the percentage on the face value of security or on the purchase price and sale price of the security? Can you answer? If the brokerage is given in percentage, then will the percentage be applied on purchase price or sale price, or will the percentage be applied on face value? The percentage will be applied on always purchase price and sale price. It will never be applied on face value. Not on face value. So this point, remember again, an important point which might give you, which might be a cause of confusion in exam. Yes, yes, yes. We'll apply it on purchase price and we'll apply it on sale price. This completes the discussion of fixed income bearing securities. Now let's start the discussion of variable income bearing security. Variable income bearing security में lot of small points are there, but don't worry, we'll discuss it. We'll quick revise each and every small point. Yes, Ram, interest percentage will be applied on face value, but brokerage percentage will be applied on purchase price and selling price. Now comes accounting for variable income bearing securities. We are going to discuss accounting for variable income bearing securities. Let's discuss the accounting for variable income bearing securities. Guys, first of all, what is the example for variable income bearing security? The example for variable income bearing security is equity shares. Investment in equity shares. Following are the important points while doing the accounting for investment in variable income bearing securities. Point number 1, dividend. Guys, dividend income is not fixed on equity shares. dividend income is not fixed on equity shares. It depends upon the profit earned by the company. Therefore, when investment in equity shares is done, if I purchase the equity shares of Hindustan Unilever, there is no concept of accrued dividend. Whenever I purchase the debenture of Hindustan Unilever, there is a concept of accrued interest. I have to pay to the previous owner accrued interest. But when I purchase equity shares of Hindustan Unilever, we can't determine the accrued dividend because dividend income is variable, it is not fixed. So the entire amount which I will pay for buying the equity shares of Hindustan Unilever, full amount which I will pay will be debited to investment account. This is the biggest difference between purchasing debentures of Hindustan Unilever and purchasing equity shares of Hindustan Unilever. When we buy debentures of Hindustan Unilever, the amount paid is bifurcated, split into towards debenture and towards accrued interest. Because we can't find out the accrued interest because the interest is fixed. The amount paid towards accrued interest will be debited to interest account, and the amount paid towards debenture will be debited to investment account. But in case of equity shares, dividend income on equity shares is not fixed. It depends upon the profits earned by the company. Therefore, whenever we buy investment in equity shares of any entity, there is no concept of accrued dividend. Full amount paid is only towards investment and it will be debited to investment account. First point. Second point. Dividend can be of two types: interim dividend, final dividend. Interim dividend is the dividend which is declared between the two AGMs. It is declared by the board of directors. Interim dividend, once declared, cannot be cancelled. Final dividend is the dividend which is declared at the AGM. It is recommended, proposed by the board of directors and declared by the shareholders. Once the final dividend is declared, it cannot be cancelled. I repeat once again, dividend can be of two types: interim dividend, final dividend. Interim dividend is the dividend which is declared between two AGMs. It is declared by the board of directors. Final dividend is the dividend which is declared at the AGM. It is recommended or proposed by the board of directors but declared by the shareholders. Once final dividend is declared, it cannot be cancelled. As per Accounting Standard 9 on revenue recognition, dividend income should be recognized when the right to receive the dividend is established. Therefore, final dividend is recognized as an income when it is declared at the AGM, but interim dividend would be recognized as an income only when it is received. Interim dividend would be recognized as an income only when it is received. Final dividend is recognized as an income when it is declared at the AGM. Now, journal entries for dividend income. Guys, when dividend is declared at the AGM, we pass an entry: a dividend receivable account debit to dividend account, and when the dividend is received, we pass an entry: bank account debit to dividend received. I repeat, when the dividend is declared at the AGM, we pass an entry: dividend receivable account debit to dividend, and when the dividend is received, we pass an entry: bank account debit to dividend receivable. if the question does not give us the date on which the dividend is declared, but gives only the date on which the dividend is received, then we will book the dividend income on the date on which it is received. We will pass an entry bank account debit to dividend. This point I will repeat once again. If the question does not give us the date on which the dividend is declared, but gives only the date on which it is received, then we will record the dividend income on the date on which it is received by passing an entry bank account debit to dividend. Normally, dividend income at year end, normally the dividend income, if I have purchased the equity shares of Hindustan Unilever, the dividend income earned by me on those equity shares normally at year end is transferred to P&L account. But as per AS 13, when dividend is declared out of pre-acquisition profits, then it should be credited to investment account so as to reduce the cost of investment. Normally, dividend income at year end is transferred to P&L account. But as per accounting standard 13, when dividend is declared out of pre-acquisition profit, it should be credited to investment account so as to reduce the cost of investment. So what is this pre-acquisition dividend? What is the meaning? Pre-acquisition dividend refers to the dividend received for the year in which Mayur sir was not the shareholder of Hindustan Unilever. Sir, how, if you are not the shareholder of Hindustan Unilever for a particular year, then why will Hindustan Unilever give you the dividend? How can you receive the dividend? Guys, this situation arises when the shares are acquired by Mayur sir. Mayur sir is acquiring the equity shares of Hindustan Unilever after the year end. I am acquiring the shares of Hindustan Unilever after the year end, but before the record date. So before the record date, what is record date? Record date is the date on which company would see its records for determining which shareholders will get the dividend. So I acquired the equity shares of Hindustan Unilever in 21-22. I was not holding the shares during 2021. During the year 2021, I was not holding the shares of Hindustan Unilever. I acquired the shares of Hindustan Unilever in the year 21-22, but before the record date. So on the record date, in the records of the company, I am the shareholder of the company, even though I was not holding the shares of the company during the year 2021, but still I will be eligible to receive the dividend for the year 2021 because on the record date my name is appearing. Such kind of dividend is called pre-acquisition dividend. Once again, pre-acquisition dividend refers to the dividend received for the year for which we were not the shareholder of the company. It will arise only when the shares are acquired after the year end, but before the record date. And record date is the date on which the company would see the records for determining which shareholder will get the dividend. What will be the journal entry? The journal entry for receipt of pre-acquisition dividend is, when we receive pre-acquisition dividend, the journal entry is bank account debit to investment account. We credit the pre-acquisition dividend to investment. We credit the pre-acquisition dividend to investment. For example, suppose our year is starting on 1st of April 2020. Suppose on 1st of April 2020 is the start of the year. Suppose the accounting year ends on 31st March 21. On 31st of May 2021, Board of Directors did a meeting and the financial statements are approved on this date. The financial statements are approved on this date. And then the directors recommended a dividend based on the profits earned by it during 2021. So recommended dividend on 31st May 21. Then on 30th June, shareholders will adopt the financial statement. Shareholders adopts the financial statements. And 1st July 2021 is the record date. Whoever is holding the shares of the company on 1st of July, that person will be eligible to receive the dividend of the year 2021. And the dividend was received on 20th July 21. Suppose the company paid the dividend on 20th July 21 to the person who was holding the shares on 1st of July. Now, in this example which we have discussed over here, guys, in this example, dividend for the year 2021, is declared on 30th June in the AGM. It is declared on 30th June and it is paid on 20th July 21 to the person who is holding the shares on 1st of July. If Mayur sir acquires shares of Hindustan Unilever after the balance sheet date, but before the record date, in this period if acquire the shares of Hindustan Unilever, then Mayur sir will be entitled to receive the dividend for the year 2021. Although I was not holding the shares, these shares in 2021, such dividend will be called pre-acquisition dividend and will be credited to investment account. So this is the revision of pre-acquisition dividend. Now let's do the revision of the next point, which is bonus shares. Let's talk about bonus shares. Guys, bonus shares are the shares issued by the company free of cost to its existing shareholders of the company without any consideration. Because of bonus issue, the assets and liabilities of the Hindustan Unilever remain same. The valuation of the company remains same. Only the profits are getting converted into capital. As the number of shares increases, the market value per equity share goes down proportionately. The only purpose of bonus issue is to make the shares more marketable. From investors' point of view, from Mayur Sir's angle, the number of shares in my hands increases, but market price per share proportionately decreases, leading to no benefit, no loss to Mayur Sir. My position remains same only. Therefore, there is no entry in Mayur Sir's books for receipt of bonus shares. While preparing the investment account ledger, we will write the number of shares received as bonus in the nominal value column, in the number column, but we will not write anything in the amount column. We will not write anything in the amount column. We will write only in the nominal value column or number of column. The number of shares in my hands will increase. I don't have to pay anything for it. Fine, sir. Next, right shares. First of all, what are right shares? Right shares are the additional shares issued by Hindustan Unilever to the existing shareholders, generally at a price lower than the market price. If Mayur sir purchases the shares offered under right, that is, if Mayur sir buys the right shares, the money spent on buying the right shares will be added to the cost of investment. Maltesh, as per Schedule 3, dividend will be declared will be shown in the notes to accounts. As a footnote, it will be shown as per Schedule 3. Footnote. Footnote, not inside the balance sheet, outside the balance sheet. So, right shares are the additional shares which are issued to the existing shareholders of the company, generally at a price which is lower than the cost price, market price, sorry. If the investor, Mayur sir, buys the right shares, then the money spent on buying the right shares will be added to the cost of investment. As per section 62, which we did the revision yesterday, as per section 62 of Companies Act 2013, guys, if the shareholder doesn't want to purchase the right shares, he can renounce his right to someone else. I can give the right to purchase the shares to somebody else. Amount received on renunciation of right will be credited to P&L account, but there is one exception. Will be credited to P&L account. But there is one exception. We are going to talk about that exception. So, amount received on renunciation of right will be credited to P&L account. Suppose Mayur sir holds 100 shares of Hindustan Unilever having a market value of rupees 15 per share. B Limited offered right shares in the ratio of 1:1 at rupees 10 per share. If Mayur sir purchases or subscribes to those right shares, then the money spent by Mayur sir on purchasing those right shares will be added to my cost of investment. I repeat once again, Mayur sir holds 100 shares of Hindustan Unilever. I am holding 100 shares of Hindustan Unilever. The market price of these shares is 15. Hindustan Unilever has offered right shares in the ratio 1:1 at rupees 10. Now, if Mayur sir buys the right shares, then the money spent on buying the right shares will be added to the cost of investment. I will pass an entry, investment account debit to bank. 100 shares. How much money we have spent in buying? 10 rupees. So this 1000 rupees will be debited to my investment account. But if Mayur sir renounces his right to his friend Ravi Khan sir at rupees 2 per share, the right to purchase the shares, I gave it to my friend at 2 rupees per share. I sold the right to my friend. Then the entry will be bank account debit to P&L account. The money received on sale of right will be credited to P&L account. The money received on sale of right will be credited to P&L account, but it is subject to one exception based on which in the previous attempts RTP they asked one question. Now read this. If the right shares are acquired on a cum right basis, this is very, very important. If the right shares are acquired on a cum right basis, then the market value of investments immediately after their becoming X right is lower than the cost for which they were acquired, then the sale proceeds of right is applied to reduce the carrying amount of such investments to the market value. So we didn't understand what is. I will tell you what it is. See all of you. First April to 31st March. Hindustan Unilever announced that it will issue right shares. On 30th June, it has announced that it is going to issue right shares. And the right shares will be allotted on 15th of July. Mayur sir acquired the shares of Hindustan Unilever on 1st of July. So when I acquired the shares of Hindustan Unilever, this is called cum right purchase. Means I have purchased the shares of Hindustan Unilever after Hindustan Unilever has announced the right shares, but before the allotment of right shares. So whatever shares I have purchased on those shares, I am eligible to subscribe to right shares of the company. I purchased the shares at rupees 15. I repeat once again, Mayur sir purchased 100 shares of Hindustan Unilever. When did I purchase? After the company has announced that it is going to issue right shares to the people who are holding the shares of the company on 4th of July. 4th of July is the record date. And I purchased the shares on 1st of July. So this is called cum right purchase. On these 100 shares, I am eligible to subscribe to additional shares of the company. How much money did I spend? 15 rupees. So 1500 rupees I have spent. This is called cum right purchase. Now, since I acquired the shares of Hindustan Unilever before the record date of 4th of July, so I am eligible to subscribe to additional shares of the company in the ratio 1:1. That is more 100 shares I can acquire. But I didn't acquire. I sold those shares at rupees 2 and I received 200 rupees. After 15 July, the market price of the company shares, after the right shares were issued, after 15th of July, the market price of the company shares were 14.5. I acquired for 15 rupees. The market price is 14.5. The decline is 0.5. So my loss is 100 into 0.5, 50 rupees is my loss. AS 13 says that whatever money you have received from the sale of right, to the extent of decline in the market price of the share, credit the investment account, balance amount you transfer it to P&L account. Whenever we receive money from the sale of right, we normally credit the amount received on the sale of right to P&L account. But if we acquired the shares on come right basis and the market price of the share after the market price of the share after the right shares were issued is less than the cost at which we acquired it, then the decline, to the extent of decline, the money received from the sale of right should be used to reduce the cost of investment. So the entry will be whatever money we have received from the sale of right, bank account debit 200, 50 rupees we will credit to investment account, balance amount will credit to P&L account. This is what this paragraph is telling. Refer the RTP of May 2021 attempt. You will get a question on this. Refer RTP of May 2021. You will get a question on this particular adjustment in that RTP. So if the normally whatever money we receive from the sale of right, we credit it to P&L account. But if the shares are acquired on come right basis and the market price of the share after the right shares have been issued is lower than the cost for which we acquired it, then the sale proceeds of right will be used to reduce the cost of investment, to bring it to the market value. Fine. The next topic of discussion is reclassification of investments. Any doubt you will have till here, please do ask. Any specific point which you want me to discuss, that sir, could you please explain this particular point in this particular question? You ask me, please. Reclassification of investment. Guys, when long-term investments are reclassified as current investments, the transfer are made at lower of cost and carrying amount on the date of transfer. But when the current investments are reclassified as long-term investments, the transfers are made at lower of cost, not carrying amount, I said cost, and fair value on the date of transfer. Any reduction in carrying amount or any increase in carrying amount arising due to reclassification will be transferred to P&L account. Let's take one example to understand this. Suppose current investments are reclassified to long-term investments. Okay. In the last balance sheet, the cost of these investments was 100 and the fair value was 90. So carrying amount of these investments, carrying amount means the value at which these investments appear in the balance sheet is 90. At the time of reclassification, the fair value is 95. The fair value is 95. If I ask you, find out the profit or loss on reclassification, you will say, once again, I will repeat the example, those who didn't catch. This is the balance sheet date, 31st March 21. In our balance sheet, there are some current investments in the asset side. The market price, the fair value, rather I should say, on 31st March 2091 of these investments was 90 and we purchased it for 100 rupees. Since these are current investments, these will be valued at lower. So we valued it at lower. The value at which the investments appear in the balance sheet, that value is called carrying amount. Suppose on 30th June, we decided to reclassify these investments from current to long term. We decided to change its classification from current to long term. And on 30th June, the fair value of these investment is suppose 95. I am asking you, what will be the profit or loss on reclassification which will be transferred to P&L account? You will say, if current investments are classified as long-term investments, current investments are classified as long-term investments at fair value on the date of transfer or cost, whichever is lower. Fair value on the date of transfer is 95 or cost whichever is lower, so the transfer will be made at 95. But right now these investments are appearing at 90 rupees in the books and we have to increase the value to 95. We have to bring them to 95. So there will be a profit of 5 rupees. Right now in the books the investments are appearing at 90, but the reclassification takes place at 95. So the profit on reclassification is 5 rupees. That will be credited to P&L account. Suppose I change the example. Suppose the fair value is 85. Whenever current investments are reclassified to long-term investments, the transfer takes place at fair value on the date of transfer or cost, whichever is lower. So the transfer will take place at 85. But right now the book value of investment is 90. So 90 ka investment will become 85. So there is a decline in the value of investment. So that decline of 5 will be called loss on reclassification and will be debited to P&L account. Will be debited to P&L account. This completes the revision of investment accounting. Any doubt, anybody, in the investment accounting? Any particular thing you want to ask? Okay, then thank you. See you at yeah, Vanshika. Renunciation. I explained, no? Just now I explained renunciation. Which part you want me to explain? Just 2 minutes back only I explained this part. You want me to again explain renunciation? See, whenever you purchase the equity shares of a company, and if that company comes out with additional issue of shares, then it is known as right shares. So right shares are the additional shares offered by the company to the existing shareholders at a price which is Bhavya, just a few sessions we have done on YouTube, few sessions we are revising on this Unacademy channel. But I will take up Vanshika's doubt. Guys, Vanshika, right shares are the additional shares which are issued to the existing shareholders of the company. Generally, they are issued at a price lower than the market price. So, if Mayur sir is holding equity shares of Hindustan Unilever, and if Hindustan Unilever comes out with right issue, since I am the existing shareholder of Hindustan Unilever, I am eligible to purchase the additional shares offered by them at a price generally lower than the market price. Now, two things can happen. Either I will purchase it or I will renounce it. If I purchase it, the amount spent in purchasing the shares, I will debit it to investment account. I will pass an entry investment account debit to bank. But suppose I renounce it. I don't purchase the shares offered by Hindustan Unilever, additional shares offered by Hindustan Unilever to me, but I sell that right to purchase to my friend at 2 rupees per share on 100 shares. So that 200 rupees which we receive, the amount which we receive on the sale of the right, as per AS 13, it will be credited to P&L account if nothing is mentioned. Entry will be bank account debit to P&L account. Put it in the P&L account. Sale of right. But there is one exceptional situation which they asked in RTP May 2021 attempt. Now, what is that exceptional situation? If the shares are acquired on come right basis and the market price of the shares after the shares becomes X right is lower than the cost at which we have acquired it. Suppose we acquired the right shares at 15 rupees. Market price after the shares have become X right is 14.5. So there is a decline of 0.5 per share into 100 shares, 50 rupees ka decline hai. So whatever money we have received from the sale of right, don't put it to P&L account, 50 rupees credit to investment account. Use 50 rupees to reduce the cost of investment, balance 150 rupees, you put it to P&L account. Thank you all of you, all the very best. We will again meet at 7:30 in the next YouTube session. And this time we will be revising another chapter. Thank you. Bye-bye.